Welcome back to the trading floor. I'm David Axtell. This is episode 9. We're starting part 3 of our series, Forwards, the instruments that let corporations, investors, and institutions lock in future exchange rates today. Simple concept. Profound implications. If you've been following the podcast, we've covered spot FX, mechanics, pricing, execution, settlement, everything happening today for value 2 business days from now. Forwards extend that framework into the future. 3 months, 6 months, 1 year, 5 years. You agree today on the rate. You exchange currencies at a future date. The hedge is locked. Why does this matter? Because businesses operate in the future, not just today. A European manufacturer imports raw materials from the United States. Payment due in 90 days. 10 million euros worth. The problem? They don't know what exchange rate they'll face. Today, euro-dollar trades at 1.0850 10 million euros. Costs $10,850,000. Budget locked, finance approves, operations proceed. But 90 days from now, euro-dollar could be 1.1200. Same 10 million euros now costs $11,200,000. That's $350,000 more. Margin evaporated. Project unprofitable. Forward contracts solve this problem. They eliminate exchange rate uncertainty for known future cash flows. Let me explain how they work. A forward contract has 5 essential terms. These 5 terms define the transaction completely. No ambiguity, no interpretation, just contractual clarity. First, currency pair. Which currencies are being exchanged? Euro-dollar, dollar-yen, cable. The pair determines which currency you're buying, which you're selling. Second, notional amount. How much of the base currency? 10 million euros, $50 million, 100 million yen. The quantity determines the economic exposure. Third, forward rate. The exchange rate you've agreed to. Not today's spot rate. The rate for settlement on the future value date. This rate is locked. Contractual. Binding. Fourth, value date. When the currency exchange happens. Not trade date. Not spot date. The specific future date when both parties deliver their currencies. Fifth, settlement method. Physical delivery or cash settlement. Physical means full currency exchange. Cash means a net payment representing the difference between contracted rate and market rate at maturity. These 5 terms create a complete forward contract. Let's walk through our manufacturer's example. European company. 10 million euro payment due in 3 months. Buying euros forward from their bank. Currency pair, euro-dollar. They're buying euros, selling dollars. Notional, 10 million euros. Forward rate, 1.0825. Spot today is 1.0850. The forward rate is slightly lower. We'll explain why in the next episode. For now, just know they've locked 1.0825. Value date, June 15th, 90 days from today's trade date. Settlement method, physical delivery. The company will pay $10,825,000. The bank will deliver 10 million euros, full currency exchange. The contract is now binding on both parties. What happens over the next 90 days? Euro-dollar spot rate moves around, up, down, volatile, doesn't matter. The forward contract is locked. Suppose on June 15th, spot euro-dollar is 1.1000. The market rate, without the forward hedge, buying 10 million euros at market would cost $11 million. But the company has a forward contract at 1.0825. They pay $10,825,000. They saved $175,000. The hedge worked. Now suppose instead euro-dollar fell to 1.0500 on June 15th. Market rate is lower than the forward contract. Without the hedge, 10 million euros costs only $10,500,000, but they're locked into the forward at 1.0825. They pay $10,825,000. They lost $325,000 compared to the spot market. But here's the critical point. That's not a loss. That's the cost of certainty. When they entered the contract 90 days ago, they didn't know where euro-dollar would be. It could go up, it could go down. By locking the rate, they eliminated uncertainty. They could budget accurately, plan operations, manage margins. That's the function of forwards. Not speculation, hedging, eliminating risk. Forwards differ fundamentally from options. This distinction matters. An option gives you the right, not the obligation, to exchange currency at a specified rate. If market moves favorably, you let the option expire. You participate in the better market rate. If market moves unfavorably, you exercise the option. You get protection. Options cost premium. The flexibility has a price, typically 1 to 3% of notional for 3-month options on major pairs. A forward is an obligation. Both parties must perform. You lock the rate, good or bad, no optionality, but also no premium cost, just the contracted rate. For hedging known exposures where you want budget certainty, forwards are appropriate. For hedging uncertain exposures where you want downside protection but upside participation, options are appropriate. Different instruments, different use cases, both legitimate. Now let's talk about settlement. Physical delivery versus cash settlement. Physical delivery means on the value date, both parties exchange the full currency amounts. The company transfers $10,825,000 to the bank. The bank transfers 10 million euros to the company. This requires both parties to have funding. The company needs dollars, the bank needs euros. They need accounts in both currencies, payment instructions, correspondent banking relationships, operational infrastructure. Most corporate forwards settle physically because corporations actually need the foreign currency for real business payments. They're not hedging for speculation, they're hedging operational cash flows. Cash settlement eliminates the currency exchange. Instead, one party pays the other, the net difference between the contracted forward rate and the prevailing spot rate on the value date. Using our example, suppose on June 15th, spot is 1.1000. The company's forward is 1.0825. The difference is 1.1000 minus 1.0825 equals 0.0175. 10 million euros times 0.0175 equals $175,000. The bank would pay the company $175,000 as the cash settlement. This eliminates the need for the company to have funding in place. No $10 million payment, just a $175,000 net settlement. Operationally simpler, lower principal risk. But it requires the company to separately source the 10 million euros for their actual business payment. The forward provided economic hedge, not currency delivery. Cash settlement is common for financial hedging. Investors, asset managers, hedge funds. They want FX exposure management, not currency for payments. Physical delivery is common for commercial hedging. Corporates, operating companies, they need actual currency for actual payments. Value dates follow specific conventions. This gets operationally important. Most currency pairs have T+2 spot settlement. Trade today. Spot date 2 business days forward. A 1-month forward builds from that spot date. Trade Monday, February 5th. Spot date Wednesday, February 7th. 1-month forward value date Thursday, March 7th. 1 calendar month beyond spot. But you need to check holidays. In both currencies. If March 7th is a weekend or holiday in either the US or Europe, the value date moves forward to the next mutual business day. This is called modified following convention. The date moves forward unless that would push into the next calendar month, in which case it moves backward to the last business day of the original month. Getting value dates wrong causes operational failures. Settlements fail, hedges break, treasury scrambles to fix. This isn't theoretical. It happens, frequently, to people who don't check calendars carefully. Let me close with why forwards matter beyond the mechanics. Over $1.3 trillion of forwards trade daily. That's Bank for International Settlements data. More than spot FX volume, more than FX swaps. Why? Because every multinational corporation Every international investor, every bank with cross-border activity faces future FX exposures. Those exposures create risk. Forwards manage that risk. When an American company signs a contract to export goods to Japan with payment in 6 months in yen, they've created FX exposure. A European pension fund investing in US equities creates FX exposure. A bank making a dollar loan to an Australian borrower creates FX exposure. Forwards let all these participants hedge, lock rates, eliminate uncertainty, plan operations with known exchange rates. The forward market's depth reflects its fundamental role in global commerce. Without reliable forward markets, international trade becomes riskier, capital flows become more uncertain, business planning becomes harder. Forward contracts make the global economy work. Next episode, we'll cover forward pricing, how banks calculate forward rates, why they differ from spot rates, the relationship between interest rates and forward points, the mechanics of the forward curve. I'm David Axtell. Thanks for joining me on the trading floor. If you're finding this series useful, subscribe wherever you get your podcasts. We release episodes weekly. For comprehensive technical coverage, FX Cash Products by Luigi Rondinini and myself covers forwards, swaps, NDFs and settlement in institutional detail, available through Rondinini Publishing. And if you need specialized resources, visit learn.rondinini.com for professional mini manuals and Python tools built for practitioners. These aren't academic exercises. They're production-ready implementations of forward pricing, mark-to-market valuation, and hedging analytics. For corporate treasury teams needing consultancy on FX risk management frameworks, hedging policy design, or execution strategy, I work with clients through axtellconsulting.net. That's my consulting practice focused on institutional FX markets. You can find more about my background as an FX markets expert, author, and podcast host on the website 35 Years Across Dealing Rooms in London, Riyadh, Doha, Dubai. If I can help your organization think through FX challenges, reach out. See you in episode 10.